In today's big interview, Stefano Marani, the Chief Executive of Renergen. Welcome, Steph. It's a big story. The Renergen story has been one that has captured the imagination of South African investors, particularly small cap investors, and some of the smart analysts. Keith McLachlan, we'll talk about him in a moment, but not so good over the past few months. Share price down by about a third. There's all kinds of rumors going around. And given that there's so many people who have an interest in your company, I'm appreciative of the fact that you've managed to give us some time to actually talk through things. Let's just start off at the obvious beginning, which is Ivanhoe, Mr. Robert Friedland. Fried is a guy who some people think is a bit dodgy to start off with. You have to only read the Isaacson biography of Steve Jobs to realize why they believe he's dodgy. But you were going to be his partner, or are his partner, or he did a due diligence and then didn't take up more stock with you. What's the relationship with Ivanhoe and indeed Mr. Friedland?
So they are a shareholder, a happy shareholder. Alex is still on the board. The long and the short of it is that the transaction was entered into pre-war. And pre-war, pre-Russia's invasion of the Ukraine, the transaction made a lot of sense for both counterparties. There were certain provisions in that agreement which were necessary to be able to get board approval from their side, but that weren't likely to be exercised. However, after the Russian invasion of the Ukraine, copper took a hammering. There was a massive downturn in certain commodity markets. And post-war, the transaction just did not look as good as it did pre-transaction for either counterparty. From our perspective, because the transaction allowed for an enormous amount of upfront dilution at a critical point in our juncture when it just wasn't going to make sense. The other thing was that it allowed them to be able to settle the stock with TSX shares. Now, that in and of itself was fine, except that the TSX doesn't allow you to sell TSX shares for 6 months. And if we're sitting in a position where we have a whole bunch of TSX shares and we can't do anything with them, we can't actually raise the cash to build phase 2. So from a regulatory perspective, there was no ways that the Reserve Bank was actually going to approve the transaction in the first place, because that was that became the intention. And so, long story short, what was a sweetheart deal to begin with, after the invasion took place, from a regulatory perspective, there was very, very little chance that we were going to get the deal across the line in the prevailing macroeconomic climate after war. So, we were both quite mature about it and just said, listen, this is not a deal that's going to work.
Why Ivanhoe, though?
So Ivanhoe doesn't only play in copper. Ivanhoe plays in a number of strategic minerals. And obviously helium is critical to United States national security. So helium, from his perspective, helium became an interesting mineral to add to that portfolio. From the secondary aspect, they've got a very big operation that they're busy building down over here in South Africa called Platreef. And that's going to be according to them, it'll be the biggest platinum mine in the world, if everything goes according to plan. It needs an inordinate amount of power, and with energy scarcity in South Africa, the way that it is and the way that it's rolling out, it became a perfect blend on two fronts. Firstly, add to the critical minerals that they already mine, such as cobalt and all sorts of other rare earth elements. And helium it's a rare earth element. It's not an industrial gas. And then obviously power for their local mining operations. Like I said, pre-war, the deal made an inordinate amount of sense for both parties.
That's so interesting, because the platinum mine has been spoken about for, well over a decade. Maybe one day it will come forward, and I can understand what you say there about the energy equation, because in South Africa that is a big issue. All right, we've pushed that to one side. Just for background, for those who stumbled onto this interview and don't really know what Renergen is, you've got a deposit in Virginia, in the Free State, where there's helium and perhaps other fracking gases. The LMG you talk about, so you'd be able to it's an energy play as well. But you've been talking for a while now about phase 1 and phase 2. Phase 1, a pilot plant. Phase 2, full-scale industrial production. That's what people are betting on. It's a bit like a junior miner, quite speculative, but quite exciting on the upside. But the delivery is all important. And I guess that's really where the concerns might lie. And that might be why your share price has been under a bit of pressure, because you were expected to have started producing already in the beginning of this year. What is the phase, what is the stage now of, or what is the point of stage 1, the pilot plant that you have been talking so much about?
Yeah, so to say that we were expected to start producing beginning of this year, that was a target set down in 2019 prior to COVID. So obviously COVID changed the game for everyone.
Sorry, Steph. No, but when you were interviewed by my colleague on BizNews, you still said it was January, February. That was only 2021. When you were interviewed, you said you were going to be producing February, March, I think it is. I can send you that interview, but sure, I know there was COVID, but in the middle of COVID, you were interviewed and you said it was coming. What happened?
Yeah. So in terms of the delays, where we got to was with the turn on the revised schedules with the turn on, we would have seen the plant come online commissioned in August, and then coming online in production in September. We managed to get the plant into production in September, and by production that means bringing the LNG online first, and then you go systematically through the different modules. There are 3 modules. There's an LNG module, and then there's a nitrogen module, and then there's a helium module. And you need all 3 running in order to produce liquid helium. Once we'd fully commissioned and got the LNG system working and in full production, we then turned our attention to the nitrogen module, got that under wraps, got that working, and got the helium module switched on. Helium going into the plant was great. Helium recoveries were excellent. We were about 10 hours away from reaching liquid helium status in the liquid helium tanks. And then one of the system utilities, a conduction oil system, went down. Now, this isn't part of the plant; it's one of the ancillary systems. So part of the process of liquefaction of gases is a compression expansion cycle, and that needs compressors. The compressors use a very specific kind of oil. The oil needs to be heated, and long story short, there's a conduction heating oil system which makes gets the oil to the right temperature, and it operates off a number of burners. The installer hadn't installed the conduction oil system properly. It had worked on and off, but once it was stable, we got the plant working to within literally 10 hours of liquid helium, and then the conduction oil system went down. We could have pushed through, we could have reignited it, and we could have taken it to the point where we got liquid helium produced and made the announcement, but the fact of the matter is that we still would have had to have shut the plant down to repair that system. And then you're also adding an inordinate amount of additional risks to the helium plant, which is quite sensitive, by going ahead and doing that and running with a potentially faulty system. So we decided to do make the hard decision and be responsible about it, shut the plant down. We have subsequently removed the conduction oil system. We reinstalled the conduction oil system. That is now operating 100%. So since then, turned the plant on, and now we're going through the motions of turning the plant back on to full operational capability.
Well, that's an interesting story. Who produced it for you? Hopefully there's a big insurance claim, because if you have a look at the opportunity cost, this must be enormous.
Yeah. So look, I mean, there are a number of claims that are possible under all of this. Right now, the primary focus is to make sure that we just get the thing turned on and get it fully operational. It is part of a larger contract. It is part of a larger turnkey EPC contract, and so it's the contractual claims are always going to take a while to work through the system after the fact, but it's certainly something that we're keeping our eye on.
But I guess the most important thing is, when will you now be producing liquid helium?
So liquid helium is very. I'm loath to give an exact date, but it's very close. It's very, very close. It's not it's not months away. Let's put it that way.
And with the production of the pilot plant, is there going to be enough generated there to turn Renergen, the listed company, into profitability?
Yes, phase one is profitable. It washes its face and it produces positive EBITDA, and that's the important thing.
But the big game is phase 2, and how much bigger is that plant going to be? Because I guess anybody can understand, you put a pilot plant together, if it works, then you've got the template for something much bigger. How much bigger is phase 2 than phase 1?
So to put it into context, it's phase 1 will accept 3 million standard cubic feet of gas per day. Phase 2 will accept 44 million standard cubic feet of gas per day. That gives
more than 10 times.
It gives you an idea of the order of magnitude. Now, the benefit about that is that you get massive economies of scale. So where we enjoy EBITDA to revenue margins in phase 1 of X, Y, and Z, in phase 2, those margins are completely different. These large-scale gas plants are significantly more profitable.
Complexity is also there, so it's not without risk. But a question mark over your immediate plans. I understand you were busy with a book build, and then you stopped it, and you are looking to list on NASDAQ. I understand. You need to just clarify all of this. Again, I'm bringing information that has been provided to me, not necessarily in the public domain. But if you are able to just tell us what happened with the book build, and secondly, what is going on with a listing on NASDAQ, given that you're an Altex listing on the JSE.
So I'll first address the capex for phase 2 and how we're getting there. The phase 2 project is about $1 billion all in US. Of that, $500 million is earmarked from the US government, from the DFC, our current lenders for phase 1. And then there's a further $250 million, which we've had several banks put some offers on the table, and we're busy working through the motions as to who the lead arranger is going to be for the remaining 250. But that gets us 750 out of the billion. A potential IPO is earmarked for back end of first quarter next year, and that'll be after we have secured the debt facilities, and we've essentially reached financial investment decision. So financial investment decision is earmarked for first quarter next year. In addition to that, there's obviously then also the Central Energy Fund, which is looking at their billion for the 10%. That's a transaction which is a work in progress, and again we're only earmarking closing that transaction when we reach FID next year. So that takes us roughly between the IPO of call it 150 million US plus the transaction with the Central Energy Fund, and then the debt from the DFC and the debt from the lender. That basically gets us to the capex needs that we have for the building of phase 2. So those are the sources and uses. In terms of the uses, it's capex for the plant, it's midstream, downstream equipment, etc. The recent placement was by all means pretty much done and dusted, other than for the fact that the Australian market tends to be quite leaky, and someone had basically leaked the transaction before we'd actually done the transaction, and so just on the basis of sensitivities, without having to go through the motions and try and get into a trading halt, which is just a painful process, because you can't put a trading halt on the JSE, and so you'd only have a trading halt on the one side and not the other, and it just causes a huge amount of confusion, as we ended up seeing after the fact, because the ASX went and put us into a trading halt in any event because someone had broken the news to the AFR. It's a difficult market. It's a difficult market to try and reconcile their legislative framework with our legislative framework. The ASX rules and the JSE rules are not exactly the most compatible in the world.
Why did you list on the Australian stock market then if it has got all these challenges associated with it?
So you only find out about the challenges after the fact. When they're wooing you in the beginning, all things are glorious and magnificent until you actually get into the position where you are listed, and then all of a sudden the game changes. But if you consider where we were back then versus where we are right now, it's a completely different ballgame. At the time, our market capitalization was probably around the 100 million Aussie dollar mark, even a little bit less. And when you look at it in that context, there were limited opportunities for us to be able to raise the capital that we needed to start building phase one, based on where we were. In South Africa, the South African market had absolutely no clue what we were about. I think to date we're still actually the only pure listed oil and gas play on the JSE. So it's a very, very lowly space over there. And shareholders in South Africa just had absolutely no clue what we were about. We were too small to list on any of the North American exchanges, or at least the United States exchanges. That left Canada, but I mean that's a horrible time zone to try and deal with. And TSX is an extremely expensive listing for a company the size that we had. And that left the only two opportunities as being AIM or ASX. The big difference: AIM is great when you have a market cap of about 200 to 250 million pounds. Then you end up being very, very liquid. Below that, you will always be illiquid. ASX, the median size of company on the ASX is about 120 million Aussie, which meant that all of a sudden, instead of being a micro or a nano cap here in South Africa, we had the ability to start playing in the mid cap space over there, and it served its purpose. It was amazing, and it got us to where we got to today. So I can't begrudge that listing. That listing has done exactly what it needed to do, and it created the visibility. But a cautionary, let it be a cautionary tale to other companies that are considering dual listings. While I've only got good things to say about the exchange on that side, just be very, very careful, because the rules between the two exchanges don't talk to each other very well.
It's an interesting. Thank you for sharing that with us. Blue Gem Research, Keith McLachlan. He loves you. He loves your company. The stock at the moment is trading at 27 Rand. He reckons it's his valuation 67 Rand and 80 Rand in a year's time. Now he's a reputable guy. He's part of the Korean Prime Concentrated Equity Fund, where they've picked 4 fund managers, and 20% of that fund is made up by what Keith likes. I don't know if Renergen's one of them, but with this kind of research from him, given that he's looking at small caps, do you have to pay for that, or does he just come to you out of his own volition? Because surely he has to earn a living somehow.
So there's paid for and there's unpaid for research. We've got several firms covering us. Out of the UK, there's a firm called Helium and Partners. They're experts in the helium space. They really understand the helium space very well. Out of Australia, there's MST, and then there's obviously Blue Gem over here in South Africa with Keith. So in the interests of full disclosure, yes, we do pay for some research. We don't pay for others. With all of these research analysts, the way that their model works is that they choose companies that they are comfortable doing research with in the first place, because they've done the work behind the scenes and they don't want their name associated with companies that they think are just going to blow up in their face. So the direct question is, Keith's research paid for? Yes, it is paid for research, but it is independent research, and we never give them anything that is private side. It's a case of the work that he does is based on public domain research, but we didn't seek Keith out. Keith sought us out on the basis that it was a stock that he already had a position in, and it was a position that he wanted to cover more closely.
Got it. Thanks for clarifying that as well. From what you said earlier, and clearly phase 2, the big plant, the 10X plant, is the one that's going to launch you into the stratosphere or not. Now, you did say that half of the equity or half of the capital fundraising there, the $500 million, is coming to you from the US Development Finance Corporation. Why are they so interested in Renergen and indeed in putting such a big slug of capital, presumably it's a loan of some sort, into your operation?
Helium. Helium is a critical mineral. It is part of the critical minerals list. It is absolutely essential in many, many fields, from rocketry to nuclear power to all sorts of things. But now the more topical aspect that it's critical to is the semiconductor industry. To give you an example, everyone talks about the semiconductor shortage that we've had for the last 2 years, which is why if you try to buy a new car, you either didn't get the car that you wanted or it had limited functionality. The fact of the matter is that the reason that you can't get the car you want is because the microchips aren't available. And the microchips aren't available because there's been a helium shortage for the last 2 years. So it all boils down to one fact that helium is critical to so many aspects of the modern economy, and we just don't realize it. And for the United States, moving from a position where they were a massive helium exporter and literally controlled most of the world's helium trade, they are now at the position where they're about to become a net importer of helium. Now, if you're sitting in a position where your economy is dependent on critical rare earth elements being produced by another superpower, and now you've got the quid pro quo that you become a net exporter of helium, you need to think long and hard about your supply chain very carefully.
Yeah, and that other superpower, of course, is Russia, who are a big producer of helium. So I guess there's that also adds in the geopolitics. Steph Marani, good talking with you. Thanks for clarifying a lot of issues. Just one final point: your share price has declined over the past few months. Any thoughts on why that would have happened, given that there was so much excitement about it initially?
Yeah, look, I think at the end of the day, it's just that we missed our targets on the turn on. And these things happen. While we're not proud about the fact that we missed the helium turn on, especially having gotten to within 10 hours of achieving it, and knowing full well what the repercussions would have been, and the fact that we were going to be hammered in the markets, we needed to do the responsible thing and protect the plant. Pushing through and producing liquid for the sake of producing liquid was not an option, not at the risk of the plant. So, I think what's reflected in the share price is a market reaction to us missing our anticipated turn on of the helium facility.
Maybe that adds to your insurance claim. Steph Marani is the chief executive of Renergen. I'm Alec Hogg from BizNews.com.